I've taken thousands of trades over the past 5 years, and I'm gonna teach you a scalping strategy that I trade in the markets every single day. This was actually the very first trading strategy that my father taught me 5 years ago when I had zero experience, and within only 3.5 months, it helped me hit my first $700 day trading in the stock market. Fast forward to now, this same scalping strategy has helped me hit close to $500,000 in trading profits over the last 10 months, which is a cumulative rate of return of over 300% on my entire trading account. And just to show you this isn't Photoshop or a screenshot, I'm gonna go ahead and refresh the page on my personal Schwab brokerage account. And if I pull up those same dates, November 1st of 2024 to September 22nd of 2025, there's the $497,000. By the end of this video, you'll know exactly how to trade this scalping strategy every single day. You'll know how to scan for these massive moves and how to capitalize on them with conviction. This video genuinely has the potential to change the way that you trade in the market. So take out a notebook, pay attention, lock in, and make sure you watch until the end of this video. I don't want to waste any more time. Let's make you a more profitable scalper. My number one goal is to keep this video as simple as possible. So even if you're a beginner day trader, you'll still be able to implement everything that I'm about to show you into your own trading, hopefully starting tomorrow. I'm gonna go step by step, and everything that I'm going to teach you, I personally use in my trading every single day. This was the very first trading strategy that my father taught me 5 years ago. And this is especially effective if you like to trade the first couple hours of the market open. So if that's you, lock in and pay attention. Step number one, we want to scan for specific stocks to apply this scalping strategy to. So every single morning at 8:30 a.m. Eastern, 1 hour before the stock market opens, I get to my office and I start creating my pre-market watch list. And I am scanning for specifically gapping stocks. So that begs the question, number one, what is a gapping stock? And number two, why am I scanning for gapping stocks? Why do I want to focus on them? So off the bat, a gap is an overnight change in price. So for example, let's say a stock closes at $5 on Tuesday at 4 p.m. Eastern when the market closes. And then the next morning, Wednesday at 9:30 a.m. Eastern, that stock reopens at $10. That $5 difference in price between Tuesday's close and Wednesday's open, that difference is called a gap. Just to show you a couple of examples so you could actually visualize what a gap is, this stock closed at $3.31 on this day, and then the next day it gapped up to $3.76. And you could literally see the gap in the price action. There's no price action between this day's close and this day's open. And this gap ended up being about a 13.69% gap to the upside. Here's another example of a gap up. This stock closed at $22.12 on this day, and the next day it gapped up about 14% to $25.27. And of course, you could literally see the change in price overnight on the charts. Here's a quick example of a gap down. So a stock that changed in price to the downside overnight. So this stock closed at $7.76 the previous day, and then the next morning it gapped down to around $7 on the dot, and you could see the gap in price on the chart. So you're probably wondering, why do gaps happen and why do I specifically focus on gapping stocks? So gaps occur because of traders and investors buying or selling in the post-market or in the pre-market. And they could be buying or selling for a number of different reasons. Maybe that company reported earnings that day, or maybe there was an event within the company, some crazy news dropped, or maybe some macroeconomic data was released, or maybe something happened in the broader market that specifically impacted that stock. The actual reason on why that stock is gapping and changing in price overnight is irrelevant. We don't care about the news. We don't care about the reason. What we care about is the effect that gap has on the price action, the effect that overnight change in price has on the buyers and the sellers. And I'm going to teach you exactly how to read that impact in just a second. And the reason I focus specifically on gaps is very simple. gapping stocks move significantly more than non-gapping stocks. And as a day trader, I want to trade stocks that have a high probability of moving 10, 20, 30, 40, 50 plus percent in a single day. And gapping stocks have that potential. They move and have way more momentum than non-gapping stocks. And that's exactly why I almost exclusively focus on gapping stocks at the open. And they also provide us traders a clear bias to trade. So 90% of the time, I am trading in the direction of the gap. So if it's a bullish gap up, my bias is going to be to go long that day. And if it's a bearish gap down, my bias is going to be to go short that day. Now, there are exceptions where I will fade the gap, where I will go against the direction of the gap, but those examples are pretty rare. Most of the time, I would say 90% of the time, go in the direction of the gap. There could be hundreds of different companies that gap and change in price overnight. And before I show you how to differentiate between a high quality gap and a low quality gap, I want to show you a bunch of different methods that you could use to scan for gaps yourself in the pre-market. So the first way is go to finviz.com. This is a really popular site for traders and investors, and go to the home screen and you should see this button right here called Screener. Go ahead and press that and then go to Technical right here. And once you're on Technical, if you go all the way to the right, you will see gap, the difference between yesterday's closing price and today's opening price. And if you click on this drop down, you could actually scan for gap ups and for gap downs in the pre-market. Now, I don't actually use this method. However, this is a good option for you. Another way that you could scan for gaps is go to marketchameleon.com, and once you're on the site, go to stocks and click on pre-market trading, and this will actually give you a report every single morning of the top gainers and the top decliners. So you could just put all of these stocks on your watch list, and it also gives you the most actively traded stocks in the pre-market as well. Now, I don't personally use this method. However, if you go to tradingview.com, and even if you have a free account, if you go to products and then click on screeners and click on stocks, you could actually scan for overnight changes in price. Click on extended hours and it will give you pre-market change percentage or pre-market gap percentage, and it will also give you post-market change percentage. So if you click on one of them and then click on sort ascending, it will give you all of the biggest gap downs. And if you click on sort descending, it will give you all of the biggest gap ups. So the way that I personally scan for gaps every single morning is I do it on my Think or Swim platform. Think or Swim is Charles Schwab's trading platform, and I highly recommend it. It's a great platform. And today was actually a pretty decent day in the markets. I finished with a little bit over $3,100 in profits, but that is besides the point. So on your Think or Swim watch list, I have a watch list here of like 5,000 different stocks. This is my stock universe. And if you go to the top of your watch list, you're going to see this section right here. And what you want to do is right click it and then press on customize. And what you want on your watch list is mark percent change. So if you actually look for that and type in mark percent, you'll see it right here, and then you'll be able to add it to your watch list. And once it's added from here, all you need to do is actually click on it, and it will sort your watch list from, by the biggest gap downs. And if you click on it again, it'll sort it through the biggest gap ups. And once I see all the gap ups and the gap downs, from there, I look through the list and I figure out which stocks I want to focus on for the stock market open. You could actually program any scanner on any platform to look for overnight changes in price. You just need to program the platform to find the percentage difference between yesterday's closing price and today's opening price. And at this point, you're probably wondering, okay, I got it. You focus on gapping stocks, but how can you differentiate the high quality gaps from the low quality gaps? And from there, that's when I filter gaps based on their quality. And there's very specific criteria that I look for when evaluating a gap. And right off the bat, when I'm reading gaps, these overnight changes in price, I am primarily looking at the daily time frame. I do occasionally look at the weekly time frame as well, just to see what the higher time frames look like to gain a little bit better perspective on what's going on with that stock. But the daily time frame is the primary time frame to read gaps. And I am looking for two simple qualities. I wanted to really simplify this so you guys could easily understand it. The first quality is I am looking for gaps that are clearing prior resistance if it's a long, or clearing prior support if it's a short. So if it's a bullish gap up, I want it to gap above resistance. And if it's a bearish gap down, I want it to open and gap below support. So that's the first criteria. And the second criteria is I want to see gaps or overnight changes in price that surprise buyers or sellers, that shock buyers or sellers, or that may end established trends. That still may sound confusing, so let's go ahead and break that down even further. So we have this move up and we have this kind of choppy price action that's occurring at the highs. Now let's say prices closed right here. Okay, and we have this very clear area of resistance that I highlighted, right? We see a high here, high there, high here, high there. Very clear area of resistance. So let's say this stock had a bullish gap up. We want this stock to open directly above resistance. So we would want it to open ideally right here, which is over the highs of all of this resistance. What we don't want to see is this stock gap into resistance. We don't want to see it open right here, because you look to the left, it's into a lot of resistance. It's into a lot of congestion. We want it to clear prior resistance. So we find this resistance area and we check, is this gapping over the highs of that resistance? Another important quality I want to talk about is we want to see it gap directly over this resistance. We don't want to see it gap way over resistance. So for example, we wouldn't want to see prices open up here. When prices are opening up here, that is way above this prior resistance. We want it to gap directly above resistance. So maybe right here or here or here, that's still kind of directly above this resistance area. We don't want it to gap way above resistance. And the same exact thing would apply if it's a gap down. We establish where is support. So we have a very clear support area here. We have a low here, low, 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 low. Even here we have a low. All right. And we want to see it gap directly below support. So if prices closed here, we would want to see a gap down right here. That is directly below the support area. We wouldn't want to see a gap into support, into all this congestion. And we also don't want to see a gap way below support. This is way too far away from support. We want to see it gap directly below, so it directly clears this prior support area. So here would be perfect, even right here or here. That's still kind of directly below support. Let's go over a few examples so you know exactly what I mean by gapping directly above resistance or gapping directly below support. And by the way, every single stock that I'm about to show you was actually on my watch list over the last few weeks, and I traded and made money on a lot of the stocks that I'm going to go over. So this stock, PL, gapped from 653 all the way to 771 the next day, which was about an 18% gap to the upside. You could literally see the gap in the chart and notice how it opened directly above this resistance. It didn't open into the resistance, into this area of congestion. No, it gapped directly above resistance. And in fact, it opened above this tail as well. This is a really good example of gapping directly over resistance, and it ended up producing a massive move to the upside. And this gap was actually the catalyst for an even bigger move over the next few weeks. Let's go over another example. This stock, TRUP, gapped from 36.41 the previous day, and it opened the next day at around 40.70. And notice how it gapped directly above all of this resistance. We have a high here, a high here, high here, high here, and we gapped directly above it. And this ended up leading to around a 10% move to the upside on the day of the gap. Let's look at an example of a stock that gapped directly under support and then actually continued the move lower. So this stock closed at 245 the previous day, and it gapped down around 30% to 171 the next day. And notice how it opened below all of this support. It opened below these lows, and notice how it didn't gap into support. It actually cleared the support, and this was, I believe, the all-time low, and it ended up producing a nice 26% move to the downside. Now, this isn't guaranteed to happen 100% of the time. There is nothing in trading that happens 100% of the time, but I want to share with you my reasoning on why I don't like gaps way over resistance or way below support. And the Intel is a really good example of that. So this Intel gapped from 2487 and it gapped almost 30% overnight. And on a $24 stock, that is a pretty significant gap. And it gapped way over this resistance area. And whenever this happens, I've noticed that these sort of gaps don't really provide follow through in the direction of the gap. So if it's a massive gap, it's pretty unlikely you're going to see significant follow through in your direction. And a lot of times they'll kind of just chop around. And in this case, the Intel actually dropped. And remember, 90% of the time, I like to go in the direction of the gap. I am looking to go long because it is a gap up. But this was way above resistance, and it ended up getting sold. And in fact, you could even create a strategy around fading a gap like this, where if it's a really, really large gap to the upside, you could actually go against the gap and trade the reversal of it. By the way, I have hundreds of hours of free education on the internet, not only on this YouTube channel, but also in my free 10+ hour trading course that is genuinely better than most paid courses on the internet. You can combine everything that I teach on my YouTube with my free course to really build the foundation for your trading. You can find my free course in the description of this video. And if you're looking for something a little bit more serious, I do personally help coach and scale traders from zero to consistently profitable. And my students trade live with me every single day. So if you're looking for a mentor that can take you under his wing, I'm happy to potentially work with you. You can apply in the description of this video as well. Let's talk about the other key quality that I look for in gaps. And I like to see gaps that surprise buyers or sellers or that end established trends. Remember, a gap is an overnight change in price. And when prices change overnight, it's pretty unexpected. And that change in price could actually shock buyers or sellers and cause them to make decisions that they otherwise wouldn't make. So here's a really good example of that. We have a nice move up, we're basing at the highs, and all of a sudden we have a massive red bar. Now maybe some of the buyers here or here took profits on this red bar, or perhaps there are some short sellers that went short and they shorted the stock, and all of a sudden it's dropping, they're making money, and they're happy. Now, prices closed right here. Now, imagine the next day, the stock opens right here, opens directly above this red bar. Don't you think that's going to shock all of the sellers who sold this stock and took profits? Don't you think a lot of those sellers might now feel FOMO that they sold way too early and that prices are going to continue higher? Or what about the short sellers? Everyone who went short here, who were betting that this stock is going to continue lower. They're making money, prices closed at the lows, and then all of a sudden it gaps above the red bar, and all of those short sellers are now underwater on their positions. What are they probably going to do? Well, a lot of them are going to cut their losses. They're going to say, okay, I'm down on the position. I don't want to lose more money, and I'm going to cut my losses. So what do? They cover their shorts, which means they're buying their shares back. And this is exactly the type of gap you want to see. And this actually creates a really interesting opportunity for us traders to go long, because this gap up shocked all of the sellers on the previous day. Let's look at this example. So we have an established uptrend. We have higher highs, higher lows, and let's say prices closed up here. Every participant within this trend every buyer within this trend is happy because prices are up here, they're all making money. And let's say the next day, some crazy news comes out about the company, they completely missed earnings, and the stock plummets overnight, and all of a sudden it opens down here. Don't you think that's going to shock all of the buyers who bought it in this entire trend, in this entire move up? Everyone who went long here, everyone is now waking up underwater on their positions. They went from making money, feeling great, to all of a sudden losing money, and their position is in the red. And let's say the stock opens and it starts to drop, and it starts to drop more, and it starts to drop more. That's going to put more and more pressure on all of these buyers to cut their losses and exit their position and sell, right? And it creates this snowball effect where the more it drops, the more pressure it applies on all of these buyers. Then all of a sudden, you'll see all of these buyers just sell and cut all of their losses. And that's what leads to a massive sell-off. And that's where we as professionals could take advantage of that shock. We could take advantage of this gap surprising all of these buyers, and we can go short and basically make money off of them selling their positions. Let's look at a fantastic example of this, and this was actually on the Qs. This is the tracking ETF for the top 100 stocks in the NASDAQ, and the Qs had 3 green days in a row. We had a green bar, green bar, green bar, and we closed at around $475. And then all of a sudden, we gapped from $475 to $455 the next day. And notice how we also cleared below the lows of this support, right? The Qs had a support right here. We gapped directly below it, and we also gapped below 3 green bars. Everyone who thought this was the bottom on the market and went long, right? They're waking up the next day underwater on their positions, and that led to a massive sell-off in the Qs because it basically trapped all of these buyers from the last 3 days. Let's take a look at this example on the WK. So the previous 3 days, we had 1, 2, 3 consecutive red bars, and we closed at 63.80 on this day. And then all of a sudden, the next day, we gap up all the way to 74.40. This was about a 16% gap to the upside. And notice how we also cleared a ton of this resistance as well. We gapped directly above this resistance. And it shocked all of the sellers or the short sellers from the previous day. Like imagine you went short right here and this thing is breaking down, it's making new lows, it's making you money, and then all of a sudden, the next day it opens all the way up here. So it shocked all of the sellers from the previous 3 days. And of course, this had a massive move to the upside. Here's another fantastic example. This was on J&J. So J&J had 1, 2, 3, 4 green bars in a row. It closed at 163.22 the previous day. And then the next day it opened at around $158. It was a very small gap down. It was only a 3% gap down. So it's not necessarily the case where the bigger the gap, the better the gap. Sometimes even 2 to 3% gap downs can be very effective. But notice how it, number one, cleared below this support. We had a clear pivot here and here. It gapped below that support area, directly below as well. And it gapped below 3 or actually 4 green bars. So everyone who was in this long over these 4 days, they're waking up to their positions underwater. And that put a lot of pressure on those buyers to actually cut their losses. And this presented an excellent opportunity for professional traders to potentially go short and take advantage of the pressure that the buyers were feeling. And this thing dropped, another 4% that day, which is pretty significant for an expensive stock like J&J. Here's another example from just a few days ago. So this stock had a move up. Then the next day it kind of gapped up and formed a red bar, and it closed at around 12.40. And then the next day it had a really small gap up, like a 5% gap to the upside. And this stock opened directly over the highs of this red bar. It opened at 13.12, and it was effectively clearing this resistance. But most importantly, it was gapping above this red bar. It was trapping all of the short sellers who maybe went short on this day, and it gapped above it, shocked those sellers, and it produced a massive move over 20% to the upside. And in fact, that gap was actually the catalyst for an even bigger move over the next few days. Step number 3, once you have your gap list, I want you to look over that gap list and find the stocks that meet the criteria that I just talked about. And what you want to do is create a favorites list of like 3 to 5 stocks, maybe 8 stocks maximum, that you can closely watch at the market open. Now, just because a stock has a very interesting gap up or gap down, it doesn't necessarily mean you're 100% going to trade it. Once you have the gap and you have the bias for how you want to trade that stock that day, from there, you need a high quality setup in the intraday timeframes. So when the market opens, that's when you go to the 1 minute, 2 minute, 5 minute, 15 minute timeframes, and you find a quality setup to trade that gap. So the daily gap, right? You look at the daily chart, that establishes the bias. And from there, you go to the intraday timeframes and you look for a setup to trade that bias. And if a specific gap doesn't form a setup, like let's say it was a bullish gap up over resistance, over a red bar, and it looked really good in the pre-market, but then when it opens, it just drops really hard and never sets up as a long, then you will ignore it. Do not trade it. In fact, most of the gaps that you have on your favorites list, you're not even going to trade, but you want to trade the ones that do form high quality intraday setups. Now, I want to repeat this and really emphasize this. Just because you have a high quality A+ gap doesn't mean you are 100% going to take that trade. Just because you have a good gap and you developed a strong bias, it doesn't mean that gap and that stock is going to follow through exactly the way that you expect. And that's why step number 4 is so important. You need to find a high quality intraday setup to trade the bias of that gap. And this strategy is particularly useful for the first few minutes of the market open, because some of these gaps, as soon as they open, they start moving. They don't wait, right? So I want to equip you with a strategy that you could trade right at the market open in the first few minutes of the day. Now, I do want to warn you, the first 5 to 15 minutes of the stock market open, that's kind of the riskiest time to trade because prices are very volatile. It's really easy to lose money. So please practice really solid risk management. You can make a lot of money at the market open because prices can move quickly, but the opposite also applies. So practice solid risk management and make sure you watch some of my other risk management videos. So this strategy is pretty simple, and it could work in the first minute of the day. It could work in the first 5, 10, or even 15 minutes of the day. So I call this the high-low pattern. You could also call it the opening range breakout. So you wait until the first candlestick forms, and if you want to go long, you place your entry above the highs of the candlestick, stop loss below. And the same thing applies if it's a short. If you're looking to go short, entry below the candlestick's low, stop loss above the candlestick's high. So it's a really easy strategy, and most traders actually enter into trades at the open randomly. They don't even size their positions. They don't even have a stop loss, and that's a big reason why a lot of traders lose a ton of money at the market open. If you do this and kind of practice this strategy, you'll have a systematic approach to it. You'll actually have an entry. You'll have a clear stop loss. And as a result, you'll be able to size your position accordingly, based on your risk. So if it's a long, you enter above the highs of the first candlestick, stop loss below. If it's a short, you go short below the lows of the first candlestick, stop loss above. So I know exactly what you're thinking. You're thinking that, hey, this is a pretty easy setup. Great. Wait until the first candlestick forms, then entry above, stop loss below. If it's a short, it's the opposite. Entry below, stop loss above. Great. But on which time frame? And that's exactly what I'm about to talk about. And this is actually a very important topic. So you have a bunch of different options here. You could do it off the 1 minute time frame, the 2 minute time frame, the 5 minute time frame, even the 15 minute time frame. Now, if you do it off the 1 minute or 2 minute, basically you're taking a trade 1 or 2 minutes into the day. Like the first 1 minute candle forms, you're immediately placing your entry above, stop loss below, or entry below, stop loss above. The same thing would apply on the 2 minute. You would wait 2 minutes into the day, and then you would do the same exact thing. Now, this is aggressive. This should only be done if you want to get into that stock as soon as possible at the market open. The reason this can be aggressive is because prices are volatile at the open. Prices can be spready at the open, and there's a high probability you might end up getting stopped out pretty quickly and easily. Now, it's high reward because you could end up getting a really tight stop, and if the trade does follow your bias and continue in your direction, you can make a ton of money, sure, but you could also get stopped out super easily. What I recommend is doing it off the 5 minute, because this is a really good balance where the 1 and the 2 minute is super aggressive, but on the other hand, doing it off the 15, you're waiting 15 minutes into the day to potentially take a trade. You might end up having a really big stop where the R to R doesn't really make sense, or maybe the trade's already going in your favor. Maybe by the time by the time 15 minutes pass by, that trade is already moving up like crazy and you completely missed out, right? So I think the 5 minute is a really good balance where it's safe and controlled, and you wait for a solid opportunity in the first 5 minutes of the day. So in that case, entry above, stop loss below, or entry below, stop loss above. Now, I would play around with this. I would experiment to see which one works for you and see which one is actually most profitable. And you can kind of, experiment, journal, and through your data, through taking a large sample size of trades, you could figure out which one is the most effective and the most profitable specifically for you. By the way, make sure you are looking at multiple time frames. So if you're doing a 5 minute high-low, entry above, stop loss below, or entry below, stop loss above if it's a short, make sure you take a look at the 1 minute time frame or even the 2 minute time frame to see how it's looking and to see if price action is aligned with the 5 minute. Before we go into the example, some other super easy criteria to follow to differentiate high quality setups from low quality setups. Always make sure the setup isn't sloppy. If you're seeing lots of tails, you're seeing lots of choppy price action, you're seeing red bar, green bar, red bar, green bar, red bar, green bar, red bar, green bar, and you don't see a lot of continuity, then don't take the trade. I actually call it Christmas lights, where it's red, green, red, green, red, green. If you're seeing a consolidation that's like that, red, green, red, green, red, green, and it just seems kind of sloppy, don't take the trade. Don't take sloppy setups. Don't take setups that have a lot of tails. And make sure you pay attention to failure patterns. So an example of this is, let's say you have a move up, consolidation, and then it attempts to break down, fails on the breakdown, continues to base. That actually makes this next breakout even more effective. Okay, so we already looked at this Core Z example, but this is actually a trade that I took and made money on just a couple of weeks ago. So this stock gapped from 1450 the previous day, and then the next day it opened at 1526. So notice how it gapped directly over this red bar. So it shocked all of the sellers from the previous day. And also notice how it gapped over resistance. So I found that super interesting. So I watched it on the intraday timeframes, and I ended up taking a setup on it at the open off the 2 minute time frame. So this was around 10 to 15 minutes into the day. We have a nice move up, we retrace, we form a higher low, we move up, and I took this as a breakout over 1550, and I put my stop loss right here at 1530. And I ended up catching this move to the upside on a breakout. So the gap was over resistance, over a red bar, and then I went to the 2 minute time frame to find a breakout. Entry right here, stop loss below, and this ended up being a fantastic trade. Next, let's take a look at the open, which was a fantastic daily gap, and it was an amazing move at the stock market open. So this open gapped from 585 on this day, and then the next day it gapped to 760 or so. So number one, notice how it gapped above the highs. It gapped directly over resistance. It didn't gap all the way up here. It also didn't gap into resistance. It gapped directly over. Perfect. It also gapped above these two red bars, and we did have this green bar in between, but that's fine. It still gapped above this sell-off and above this previous red bar the day before. So amazing. I mean, this was an A+ gap that I wanted to watch very closely at the market open, and I liked it so much that in my group, I called it as a 1 minute high low. So I called it as a long over the first 1 minute candle, stop loss below. So that was at 775. And then the stop loss was around 740, and it never took out the stop. It never took out the lows of the first 1 minute candle. So it ended up making a move up, and then it actually retraced. So even if you didn't catch this 1 minute high low, it ended up putting in a nice pullback and retracement. So you could have went long over this red bar, stop loss directly below this pivot, below the retracement, and you would have caught, this tremendous move higher. It even had a nice little breakout here where it moved up based. You could have done this as a breakout over the highs, stop loss below, and you would have caught this move as well. And it ended up continuing higher literally the rest of the day. It was just a fantastic move. And the reason I was so aggressive on this call, and I called it as a high low, is because it was such an amazing daily gap. Next, we have the Alibaba, and the Alibaba was a very interesting gap where it gapped from 143.94, and then the next day it opened at 148.04 or so. So Alibaba actually cleared a pretty major area of resistance. It cleared this prior high, but it also cleared all of the resistance all the way back here. So this was a pretty significant gap, and it was also gapping above this previous red bar the day before. So it was shocking all of the sellers from the day before, and it was also gapping directly above resistance. It didn't gap like all the way up here. It gapped directly above this previous high. So I found this super interesting, and this was basically a 5-minute high-low setup, right? If you go to the 5-minute time frame, I mean, beautiful here, right? We get two kind of doji bars, easy. I mean, entry above, stop loss below. And that was basically my original call. And if you look at the 2-minute time frame, let's say, you could really see that 2-minute consolidation, that 2-minute base breakout. So it was a 5-minute high-low, but basically that is a 2-minute breakout. And it actually set up later as a 5-minute base breakout as well, where you could have went long right here. Oops. You could have went long over the base here and stop loss directly below. Now, I didn't call this. This I actually did not catch. This was the original call, but it ended up forming another really nice breakout opportunity, and it absolutely mooned right after. So beautiful gap above resistance, above the red bar. We had an initial 5-minute high-low, 2-minute breakout, and then we had a 5-minute breakout later in the day. We could take a look at the 15. Yeah, I mean, that's a lot more clear. Look at that 15-minute breakout. That's just beautiful, right? Move up, little retrace, moved up again, red bar, nice little breakout right above the base. Beautiful move. So we already looked at this NFE gap. This was the gap that opened directly below this support. But notice how on the NFE, it also opened below 2 green bars, right? So it was shocking all of the buyers who maybe bought this as a double bottom, right? Where it retraced to this double bottom. Maybe some people went long here thinking that it was going to continue higher. All of a sudden the next day, it gaps from 245 to 174, below support, below 2 green bars. Fantastic. And then at the market open, this was just a amazing setup. This was just a beautiful 2-minute breakdown, right? Entry below the base, stop loss directly above the base. And if you look at the 5, this was basically a 5-minute kind of high-low, essentially. Yeah, even if you did it, the high-low would have probably triggered here or so, but it's basically a 1 to 5-minute base breakdown, and this thing followed through beautifully. This thing dropped 25% in basically the next 30 minutes. And that's exactly why I like to trade gaps, right? The gap was the catalyst for this play. We gapped below support, below 2 green bars, and then we found a beautiful 2 and 5-minute breakdown to trade the bias on the daily time frame. And that's why I like to trade simple setups, right? Breakdowns and retracements or high lows. That's it. I hope you found tremendous value in this video. In summary, we like to trade gapping stocks because they have way more momentum. They move significantly more. If you actually go back to a lot of the daily charts that we were looking at, on the days that the stock moved the most, it was usually because of the gap. The gap was the catalyst for its movement. And once we have our bias based off the criteria that we've learned for evaluating gaps, we look for high quality breakouts, or high quality retracements or high quality, high low patterns if we want to be super aggressive at the open. Always keep in mind that you might have 5 to 8 favorite gaps every single day, but you're probably not going to trade every single gap. In fact, out of 100 gaps, I probably only trade like 3 to 8 of them. I pass on 90% of the opportunities that I see in the markets. I pass on 90+% of the gaps that I see in the markets because I'm selective. I only focus on gaps that meet my strict criteria. I'm not in the business to take every single trade or trade every single gap. I'm in the business of taking my setups that fit my system that I'm confident I'm going to make money on. Hopefully you found a lot of value. Make sure you leave a like. Make sure you leave a comment if you found this valuable, and if you liked the video, please give me your feedback and subscribe to the channel. I'll see you guys on the next video. Thank you.